Hello everyone, and welcome to this month's member video on private credit. As quite a few of you have requested, we are going to talk about whether there might be some potential opportunities in the private credit space, given that shares of business development companies, BDCs, have fallen quite a bit lately. I've linked both our public videos on private credit from this past weekend below for those of you who may need a refresher, and would highly recommend watching those public videos first before diving into this one, because it will help you understand what private credit is, what the risks are, and what the data shows at this point in time on credit losses and defaults. Keep in mind as you go through this member video that all the numbers and information here are per market close on March 27th, 2026. And the situation is evolving quite rapidly in the private credit space. So please do check what the latest data looks like whenever you might be watching this. And especially if you're considering adding some private credit exposure to your portfolio. Recall from part 2 of our private credit mini-series that there are two ways that retail investors can normally access private credit. Through interval funds, which mark their holdings to NAV and can gate or restrict redemptions, and business development companies, or BDCs, whose shares are freely traded on exchanges. Now, if you have the risk appetite and decide for yourself that the high discounts that most BDCs currently show between market prices and net asset values might present an opportunity, here are the three topics that we'll be covering in today's member video. 1. What do the numbers tell us about some of the largest BDCs and other funds in the private credit space? 2. Who might want to consider investing in BDCs right now and who might not? And 3. Which BDC might an investor choose over the other? Let's get started. What do the numbers tell us about some of the largest BDCs and other funds in the private credit space? As so often at Diamond NestEgg, we've pulled together a table to give you an initial overview of the BDC market. In the first column, we have the name of the fund, followed by the ticker and the date it was established, as well as its latest expense ratio, the annual operating cost of the fund, expressed as a percentage of the fund's average net assets. Here we have the market cap and the forward-looking dividend yield, meaning the estimated annual cash distributions calculated by taking the most recent regular dividend payment, annualizing it, and dividing it by the current price. Here we have the discount of the share price versus the net asset value. How much cheaper you can buy the net book value of the assets, to simplify the idea. Then we have the credit rating. Remember, most private loans are not investment grade by themselves, as we discussed in part 2 of our private credit mini-series. However, because each BDC holds an entire portfolio of financings and is often very actively managed, some BDCs with a good track record can get to an overall credit rating that is better than the sum of the parts, so to speak. This explains why most, but not all, of the BDCs on our table have a rating in the BBB range. BBB, BBB, is investment grade, although at the lower end of the category. And for the sake of completeness, we have the trailing total returns here over the past year, the past 3 years, and the past 5 years. This is the total return an investor would have received from both dividends, cash distributions, and share price gains or losses had he or she invested 1, 3, or 5 years ago. As I mentioned at the beginning of this video, all the numbers and information here are per market close on March 27th, 2026. So please do check to see what the latest data shows at the time you are watching this video, given the current volatile environment. And always remember that past performance is not indicative of future results or outcomes. So let's kick off with 1X BDC Income ETF, ticker BIZD. Established back in 2013, BIZD is not a BDC in itself, but really a fund of funds which tracks the MVIS US Business Development Companies Index and holds stakes in 35 BDCs, including all 5 names that we will be discussing later. As a fund of funds, BIZD may be a good instrument if you are newer to BDCs and/or want to diversify your risk across a broader portfolio of BDCs. BIZD shows an expense ratio that probably scares off many would-be investors at first, because, well, they probably don't know what all of you will know in a moment as Diamond NestEgg VIP members. But this almost outrageous 12.86% expense ratio is not really 1X's fault, for lack of a better term. 1X itself only takes 42 basis points. The remaining 12.44% are pass-through expenses, meaning it's what the underlying BDCs in BIZD's portfolio charge investors for their services. However, the regulators require that 1X disclose not just its own fees, but those of its underlying funds as well, which, coincidentally, makes transparent that most BDCs are really not cheap at all. In any case, this 12.86%, like the other expense ratios in this table, are already deducted from dividend yields and total trailing returns here. There is no need to deduct them again. BIZD has a market cap of 1.4 billion at the time of this taping and a forward dividend yield of 13%. It does not disclose the discount versus the ultimately underlying private loans, but if we try to roughly estimate it ourselves, we get to a range of maybe around 24%, which should be more or less representative of the overall BDC market. As an ETF, BIZD has no credit rating. Here are the trailing total returns for completeness. This one-year column at more than minus 19% shows the really bad year that BDCs have been having. But it's not clear how relevant this might be otherwise going forward. Much of it will depend on whether the current private situation is really a result of too many investors wanting out of a basically illiquid investment category at the same time, or whether it's an early warning sign of deeper fundamental issues, meaning potential credit losses and defaults in private credit portfolios, as we've been discussing in our private credit mini-series. Up next, we'll walk through 5 larger BDCs that are all included in BIZD, but may be of interest to investors who want to bypass the ETF, so to speak, and invest directly. The Ares Capital Corp, ticker ARCC, the Blackstone Secured Lending Fund, ticker BXSL, the Golub Capital BDC, ticker GBDC, the Blue Owl Capital Corp, ticker OBDC, and the FS KKR Capital Corp, ticker FSK. I will only be highlighting the most important points about these BDCs in today's member video, but we will post the full table in our VIP member community so that you can download and review it at your leisure. If you have any observations, comments, and/or questions, please also drop a note for us in the member zone so that we can continue the discussion. So the first 2 BDCs here, Ares ARCC and Blackstone's BXSL, are amongst the most conservative and also least volatile in the group. Now, there's no such thing as a blue chip in the BDC world, but if there was, ARCC and BXSL would probably be the next closest thing to a blue chip, if you want. ARCC and BXSL focus on senior secured private loans, are well collateralized, and have not seen too many issues emerge from their portfolios so far. ARCC has a BBB rating from S&P, so just a slight tick better than BXSL, which has BBB-. The Baa2 rating from Moody's is the same for both ARCC and BXSL, though, and there is no negative outlook on either of these BDCs, as far as we are aware. Plus, Ares and Blackstone are seen as cautious risk managers with a high level of trust in the market. As a result, their discounts are the smallest on this table, at only 12% for ARCC and 13% for BXSL at the time of this taping. The forward dividend yields look solid as well, at 10.71% for ARCC and 13.1% for BXSL. The only fly in the ointment, so to speak, would be the high expense ratios of 12.01% for ARCC and 10.99% for BXSL. Like for all the other BDCs on this table, managers get a fixed fee of 1 to 2%, plus a success fee, an incentive fee as the industry calls it, of another 15 to 20% on top. But they are not even the most expensive ones on this table. You'll have all the numbers soon on the table if you want to take a closer look. Up next is Golub Capital's GBDC. It's very similar in many respects to Ares ARCC and Blackstone's BXSL. GBDC also has a BBB- rating from S&P and a Baa2 from Moody's, with no negative outlook from what we can see. But its discount to NAV is 17%, so a bit higher than ARCC's 12% and BXSL's 13%. And this may be the combination of a slightly higher risk profile, a bit more junior debt, with the smaller size of Golub Capital, whose name recognition may be not the same as for BDC market leader Ares and private markets powerhouse Blackstone. The smaller size may also have some impact on GBDC's liquidity, meaning that when you want to sell, you may have to wait a bit longer or accept a price that is a bit lower than you otherwise would with a BDC like Ares ARCC, which is almost 4 times larger currently at 12.5 billion market cap versus GBDC's 3.2 billion market cap. Golub's forward dividend yield of 12.23% is in the middle between Ares' 10.71% and Blackstone's 13.1%. The next two funds show much larger discounts at the time of this taping. And let's begin with Blue Owl's OBDC, which has frequently come up in our member zone. Its discount to NAV of 27% is noticeably higher than for the first three BDCs, and its 13.94% forward dividend is higher as well. Now, it does not appear that this has anything to do with OBDC's current credit ratings, which are BBB- from S&P and Baa2 from Moody's, the same as the three other funds that we just discussed. In fact, Moody's just upgraded OBDC in January. There are some news reports out there about Blue Owl's higher exposure to software and tech. So, if these are sectors that concern you, you may want to do a deeper dive into Blue Owl's holdings. What seems to be really weighing on OBDC, though, is a failed attempt to merge with its non-traded sister fund called OBDC2 back in November 2025. Now, you may have read the headlines. This proposed merger led to an uproar among shareholders in the non-traded sister fund, which then basically went into liquidation mode. Now, the real issues were all in the illiquid OBDC2 sister fund. But the whole drama clearly didn't help our publicly traded OBDC either. Some market commentators are even speculating whether OBDC might be wound down over time as well, but no one really knows right now for sure. If you want more background into the market fallout between OBDC's non-traded sister fund and our OBDC fund here, please refer back to our February member live, also linked below. We start the discussion in detail around minute 5 of the live. That said, if you are less concerned about potential credit issues, OBDC could be seen as an almost pure play on high discounts created by retail investors, all trying to get out of the door as fast as they can. This, of course, does give OBDC a different risk profile from Ares, Blackstone, and Golub that you need to have the appetite for, meaning it's riskier. And last but not least, we have the FS-KKR Capital Corp, ticker FSK. FSK shows by far the highest discount to NAV in our table, a whopping 53%, and also the highest forward dividend yield at 26.03% at the time of this taping. Now, you could say that FSK is really the highest risk, highest reward BDC on this table. The industry-wide liquidity issues impact FSK, of course, but there are some very fundamental concerns. Not only did FSK cut their dividend in Q1, they also had to take more hard write-downs than the other funds on this list, which means they've seen a noticeable reduction in their NAV, a NAV erosion, as the industry calls it. In addition, Moody's just downgraded FSK to Ba1, which is not investment grade anymore. It's in junk territory, if you want to use the label. And while S&P has kept the rating at an investment grade BBB- so far, it has attached a negative outlook. A 53% discount against NAV though, which basically means the same as buying at half price, would give you a decent buffer against future losses, in our mind, if you have the right high risk appetite. For example, if you bought at 50%, you might still see some decent upside even if the NAV fell to 75%. And that's before the coupons that you may still collect along the way. But it's clearly not for everyone, because the risks will be proportional as well. As the iron rule of finance goes, high risk, high return. And do keep in mind, the reality is that as a retail investor, you can never be 100% certain what's in these BDC's portfolios or identify any potential credit fallouts beforehand. So we do highly recommend that you go through the prospectus and check the latest market data of any BDC that you're interested in. Which leads us directly to the next part of today's discussion. Who might want to consider investing in BDCs right now and who might not? As we said before, investing in BDCs right now will not be for everyone in our community. And personally, we think that you should only consider investing in BDCs if you check all of these boxes. You believe that the current discounts for publicly traded BDCs are fundamentally more a reflection of a liquidity crunch, meaning too many investors wanting out of a basically illiquid investment category at the same time, and not an early sign of a deep and long-lasting credit meltdown. You have the risk appetite to be a bit more adventurous with a part of your investment. BDCs are not for the safe and/or stable part of any portfolio. And in particular, something like FSK, which, as we already touched upon, is essentially in junk territory with its recent credit downgrade by Moody's. You have the appropriate time horizon and financial resources. In other words, if an investment in a BDC doesn't work out as planned at all, or if you have to wait longer than you expected for the returns that you want, you will still have enough money to cover your essential and ongoing expenses. Remember, in the very worst case, you could lose your entire investment. You know that there may be an often steep price to pay if you need to make a quick exit of any kind. Remember, one of the reasons that private credit and BDCs pay such high returns is because there is an illiquidity premium. If you need to sell your BDC shares fast, your price may be lower than you had expected. And beyond the matter of illiquidity, you understand how private credit and BDCs work, including that there are no guarantees on either principal or expected income. Now let's talk about who should not invest in BDCs. You should not invest in BDCs right now if any of these boxes apply to you. You believe that the current discounts for publicly traded BDCs are a pre-warning of more credit losses and defaults to come. So basically, it's not just a liquidity crunch fueled by missteps of some isolated funds and alarmist headlines. You are a conservative investor who prioritizes safety and certainty above all else. BDCs carry a commensurate level of risk for the potential returns that they may generate, and especially in the current unpredictable and often volatile market. You don't understand or are not comfortable with private credit and BDCs for whatever reason. As I always say, sometimes that extra return is just not worth the extra risk if it keeps you up at night or makes you wake up in the morning wondering why you bought this in the first place, or whether your life savings may be wiped out. Everyone's financial journey is different. So, now that you know what our personal take is on who should and should not invest in BDCs, let's assume that you do check all these boxes here and you're ready to pick up some for your portfolio. The next step then is to figure out which BDC best fits your personal circumstances, goals, and expectations. Which brings us to the next part of today's video. Which BDC might an investor choose over the other? As many of you already know, Jen and I are still very much in the growth phase with our portfolio, given our runway to retirement, so we are primarily invested in equities at the moment, which aren't doing so great either at the moment, by the way, but let's talk about that another time. What this means, though, is that we don't own any BDCs in our portfolio right now. That said, we could see the following starting points for an investor who may want to consider adding some BDC exposure to their portfolio, starting with the most diversified fund and ending with the most risky BDC, in our mind. 1X BICD, as a diversified fund of funds, may be more suitable for newcomers to private credit and BDCs, and or if you want to truly diversify your investment. Ares ARCC or Blackstone's BXSL may be something to potentially consider for an investor who wants a BDC that's not quite a blue chip in the literal sense, but as close as you can get to a blue chip in the BDC world, meaning a BDC with potentially less risk, but also less potential return, based on its current 12 to 13% discounts. Golub's GBDC might be something to think about if you don't mind a bit of extra risk for a bit of potential extra return from the 17% discount at the time of this taping. Remember though, you will not get the same size and or name recognition that Ares and Blackstone might have versus Golub. Blue Owl's OBDC is probably the BDC that is as close as it gets to the idea of a play on the current liquidity crunch in private credit. Of course, that assumes that you think that most of its 27% discount at the moment is linked to a liquidity crisis and the hangover from the failed merger attempt with its illiquid OBDC2 sister fund, but are comfortable that there won't be too many unwelcome credit surprises at OBDC. FSK is, from our perspective, perhaps the highest risk, highest reward investment in this table, as we already touched upon in the first section. It was just downgraded by Moody's to Ba1, which is not investment grade anymore. That said, FSK's discount of 53% at the time of this taping may give you a decent buffer against more credit losses, assuming that these are not too deep or too broad. Just keep in mind though, that if more losses and or defaults start coming to light and or piling up, there may be even more market volatility And BDC share prices could keep falling further as well. There are zero guarantees. And regardless of whether you are interested in FSK or any of the other funds in this table, never put all your eggs in one basket. And especially if you've just started to dip your toes into the world of BDCs and private credit. It's generally not recommended to head straight to the riskiest investment if you're new to an asset category and just learning the basics. That's like buying high-yield corporate bonds before understanding how T-bills work in principle. That said, for the right investor with the right risk appetite, who does believe that the current discounts for publicly traded BDCs are not pre-warnings of more serious credit problems to come for the industry, the current discounts on publicly traded BDCs may be worth diving deeper into. And as a heads up, we will have another public video on private credit shortly, which dives deeper into what happened in the last episodes when BDCs were also beaten up in the market. So, what are your thoughts? Are BDCs too risky for you, or are you planning on picking up some for your portfolio? And if so, which ones? And if you already own some BDCs, what do you own? And are you going to add more at current prices, or are you just trying to ride out the current storm? Let us know in our VIP member zone. Thanks for watching, members, and see you again soon.